Bryn Jones, he's a fund manager at Rathbone Unit Trust Management with £2.6 billion in fixed income assets. Bryn, good to have you here. So, the US debt crisis, are we through the worst? Is it over now?
Well, I mean, it's a case of kicking the can down the road a little bit. They've increased the debt ceiling. The question is, have they made enough spending cuts going out to keep the rating agencies happy? There is a big question mark still surrounding that, and that could obviously have an impact going forward.
What do you expect to happen on that front? Do you think the US deserves to lose its AAA credit rating?
Well, yeah, if you took me out of this and brought me in from another planet and looked at their current debt situation, yeah, I would say yes, most likely. But obviously, clearly, it's the most flexible economy in the world. So there are question marks about whether they should get a downgrade because clearly of the sort of structural position that they're in. But based on their structural position and the budget deficit, I would suggest possibly yes.
Well, if you look at the Treasury markets, you would think there was no crisis at all.
Yeah, no, that's indeed correct. I mean, I think there's been a bit of sort of what's going on with fundamentals at the moment as well. Obviously, we had US GDP figures come in, and if you sort of take them down to look at the actual what GDP is for the first 2 quarters, it's running just shy of 0.5%. So clearly, the US needs to grow at something around 3% just to keep its debt to GDP ratio in check. So, I mean, we're looking at the numbers for the next 10 years in order to reduce debt to GDP down to about a reasonable level of 60%. Notional GDP has to run at around 5.9%, which means that inflation has to be over 3 and
they need much more in terms of cuts, is what you're saying.
Yeah.
But if we do get a downgrade from S&P or one of the other ratings agencies, what kind of impact is that going to have? Is it going to really impact the Treasury market at all?
Well, it could do. I mean, I think from the fund space, not a great deal. I mean, we're looking at a bit of Morgan Stanley research. 139 funds have AAA in their title, and they make up about $82 billion of the market. And if you think that they probably hold about 50% in US Treasuries, so that's about 40 billion of full
sales. Are they
sales.
going to make an exception and keep them if they're AA?
Well, I suspect not. If they have a strict mandate that says AAA, that would be 40 billion of sales. But then there are other parts of the market that might be impacted as well. For example, about 1.7 trillion of US treasuries are held in money market funds.
Right.
And that includes exposure to the repo market as well. And there's a question about what happens to those money market funds. One suspects they won't be full sellers, but they might be investors pulling money out. So then they have to sell their treasuries.
So where do they go? Where do you go for safety? A lot of people are now saying, a lot of economists that we have in the program, fixed income strategists, you can go to the Bund, the German Bund, but now you also have to look at Germany as a representation of the whole of the EU.
Yeah, exactly. I mean, there are big structural risks in Europe. The gilt market is seen as a good safe haven, but
here in the UK.
In terms of liquidity and size, it's perhaps not quite big enough to absorb the impact from sort of sales of US Treasuries. There are other markets developing. There's a dim sum market developing in offshore corporate bonds offshore. But again, they come with huge risks as well. So one suspects, as we've seen this week, even with the possibility of a US default, US Treasuries have actually rallied because they're more worried about the size of the spending cuts and what impact that's going to have on US growth.
But what you're saying really is that this is part of a whole shift, isn't it, from west to east?
Yeah.
It's part of a wider theme. That's the trend.
Well, in 2005, Ben Bernanke he flagged that the huge global savings glut would cause a huge impact on US deficits. It's quite clear that the Fed have been pretty quiet through this. I think they understand this structural shift is occurring, and all what we're seeing in this sort of the European debt crisis, the US deficit issues that we're seeing. I think this is only going to continue over the next 3, 5, 10 years as we see.
And at some point we'll be seeking safety in the debt of a BRIC nation, perhaps.
Well, of course. I mean, it costs less now to insure against Brazilian default than it does against US default. So, and that highlights that simple fact. Yeah.
Bryn Jones, we've got to leave it there. Fund manager at Rathbone Unit Trust Management. Thanks for being with us.